Good evening all. Hope you can all hear me loud and clear. If you can't, please send a chat message at the bottom, although you probably can't hear me saying that. So let's hope you can all hear me. Thank you for coming in today to listen to us to talk about a little bit about some of the issues of financial planning to move to the UK. Who we are, well, we are BMP Wealth. We're a Hong Kong-based company. We specialize with internationally minded clients who are looking to move to different jurisdictions around the world. And today, obviously, we're focusing on the UK. Second area we always look at with clients over time is their balance sheet, and do they have enough to live the lifestyle that they want for the rest of their lives. Surprising how many people can have too little, too much, or just the right amount of money for the rest of their lives. So today, what we want to do is focus on people moving to the UK, which is an area of need right now. I believe in terms of BNOPs, there's something like 3,000 applications a week going on to the UK at the moment. So there's a big area of need. So we're focusing on that for the time being. My co-presenter is a chap called Jason Pierce. He'll take over from me in a moment. But any questions, feel free to ask as we go through. The second half of the presentation, I'll come in, which is about half an hour, 40 minutes from now, with some examples of real life, how this all works. So please hang on to at least that bit, and then we'll do a summary at the end. Without further ado, I'll hand over to Jason. Thanks, and Jason.
Thanks, Howard, and good evening, everyone. Thank you for joining us. So the introduction then. So just before we start, if you see a term on the slide that's in green and is bold and underlined, it's referring to a legal or technical term that might have a meaning that's slightly different to its normal everyday meaning in English. There's one on the next slide. I'll show you it to explain what I mean by that. In terms of conversion, I'm just going to use 10 Hong Kong dollars to 1 sterling, keep things nice and easy. And for those that are not familiar with the UK tax system, some acronyms. Firstly, HMRC is the UK's version of the IRD. They're the people responsible for collecting tax in the UK. And then some taxes that we don't have in Hong Kong, but we very much do in the UK: capital gains tax and inheritance tax. So first thing to cover off then is, what is UK residence? So for comparison, Hong Kong residence is very simply a day count test. So if you spend 180 days of the tax year in Hong Kong, that will make you resident, or a total of 300 days spread over 2 tax years. So a very, very simple day count test to determine whether you are tax resident in Hong Kong or not. In the UK, we also have a day count test, but the first thing to say is the tax year is slightly different, runs from the 6th of April to the 5th of April for historical reasons. But it depends upon the number of days that you spend in the UK in each tax year. Now, days you'll see there is green, bold, and underlined. That's because in the context of UK residence, day actually means being physically present in the UK at midnight. So if you take a plane from Hong Kong to the UK and it lands at 5 to midnight, you will be in the UK for a day, even though it's only 5 minutes off that day. If your plane lands at 5 past midnight, that's not counted as a day in the UK. The following day is, of course, there. But there's an example of a technical term that means something slightly different to its normal English usage. Now, if you are in the UK, physically present and there for 15 or fewer days, midnights, then you are categorically non-resident in the UK. Another technical term there as well. So anyone can spend 15 days in the UK without becoming tax resident. And that's, of course, 15 days between the 6th of April and the following 5th of April. On the other hand, if you spend 183 or more days there, then you are categorically resident. Anyone that spends more than that number of days, midnights, in the UK is tax resident for that tax year. And of course, in the UK, every tax year is discrete and separate from other ones, the ones before and after. Now, what happens though if you spend more than 15 but fewer than 183 days? Well, in order to determine whether you're UK tax resident for that particular year, you will need to take the statutory residence test. So here's an example of a flow chart that my company has produced, which takes you through, just asks you some basic questions. It's one side of A4, and then at the bottom, it will tell you the number of days that you could spend in the UK without becoming tax resident, if that's something that you're trying not to be. All the accountancy firms produce these, a number of financial advisors for, this is just one example. So at the bottom of the one-sider, you'll then see there's two columns. If you're going to the UK, it's the right-hand column, which is the relevant one. The one on the left is if you're leaving the UK. So actually, if you haven't been tax resident for the three previous tax years in the UK, then you can in fact spend 45 days there without becoming UK tax resident for that year. 183 or more though, everybody is resident that spends 183 days. But if you're in between, there's actually 3 different day count thresholds which will determine whether you are resident or not: 46, 91, 121. Now these depend upon what are called your ties to the UK. That's things like, do you have a home there? Do you have a job there? Do you have family there? And a couple of others. So what it means though is that you could, if you had 4 ties to the UK, be only in the UK for 46 days of the year, but you will be tax resident for the whole year. So that can have very significant impacts. If you move to the UK sometime after April, your tax residency could in fact be backdated to when you physically moved to the UK. So for that reason, it's always advisable, where possible, to arrange your finances in the tax year prior to the one in which you intend to move. So with the 26th of April today, so a new tax year started just under 3 weeks ago. If you move between now and the 5th of April next year, there could be some tax consequences. So if you're able to defer moving there until after next 6th of April, you can do your planning in the next 9-10 months. Okay. It is sometimes possible to claim something called split year treatment, but that's a very complex subject and it's not as easy as is often assumed. Okay, to be on the safe side, ideally, if you can, start to plan in about 18 months before you intend going to the UK to get the optimum outcome. So that's UK residence. We have something else in the UK, they're called domicile, and this affects your tax in the UK as well. So residency, it's straightforward, it's complex, but it's straightforward. It's simply a day count or a midnight count in reality. UK domicile, which we've shortened to DOM, it's an entirely different legal concept. And say Hong Kong doesn't have domicile, most countries don't. The UK very much does, but it's different to where you're living and what it says on your passport. And I'll show you a real life example in just a second. So there's no single legal definition of domicile. It's very broadly the country that you have the most ties with, or the one that you would regard as your permanent home. Okay. Now, when you're born, if your parents were married on the day you're born, you inherit your father's domicile. If your parents were not married, you inherit your mother's domicile. So here's a real life example of a former colleague of mine and a friend. So Dimitri was born in London. His parents weren't married. They were in a long-term relationship, but they never got married. He spent the early part of his life in the UK. He then moved to Hong Kong and worked here for 9 years. He obtained permanent residency in Hong Kong after 7 years, but then he moved on and he's now in Australia. So he has Russian nationality from his father. So he's got a Russian passport because his father's Russian. He inherits his father's nationality. But because his parents weren't married, he doesn't get his father's domicile. He gets his mother's domicile, which is obviously a UK domicile. His mother's English. Okay. But he also has permanent residency of Hong Kong, and he can keep that if he visits regularly. But he's actually resident in Australia. So Dimitri has contacts with 4 different countries all at the same time. And some of these things will affect his tax should he ever go back to the UK. So for UK tax purposes, everyone has a domicile. But if you've got no connection with the UK and never will have, it's clearly irrelevant. But if you're joining this webinar, I'm assuming that you either do have a connection or you intend to have a connection at some point in the future. So if you've ever lived in the UK, or you're going to live there, or if you were born there, one of your parents was born there, then it is something you need to be aware of. Now, you can only have one domicile at a time, but it can be changed. So you can't be both domiciled in Hong Kong and the UK at the same time. Now, if you're a Hong Kong person, born and brought up here, and you move to the UK, the UK, and if that happens, your tax treatment as a UK resident will also change significantly. Okay, but initially when you move there, if you're UK resident but non-UK domicile, there are some very good tax advantages, which I'm going to talk about in just a second. So let's look at then its UK taxes. And for those of you that have never paid or experienced UK taxes, this may come as a little bit of a shock. First thing to say is that the Hong Kong tax and UK tax are very, very different. So the Hong Kong tax code, less than 300 pages long. Just for reasons of comparison, in Australia, it's about 6,000 pages. The last time anyone counted in the UK was 2015. At that point, it was thought to be 17,000 pages long. Now, we've had several budgets since 2015, so now it's probably more like 20,000 pages long. It's about 12 times as long as the Bible. It's very, very long. 10 million words, that's what it would look like if it was all printed out at once. Okay, now, different countries tax their residents in different ways. So I've brought it down to 4. So the first one is countries where they in fact don't tax individuals, probably most famously Dubai, where there is no personal income tax there. There's a second form that we call territorial tax, which is what we have here in Hong Kong, and in elsewhere in Asia, it's also in Singapore and Malaysia. And this is where Hong Kong will only tax Hong Kong-based income. So if you're living in Hong Kong, you have a Swiss or a Jersey bank account that pays interest, Hong Kong is not interested in taxing that. It only wants to tax local income. But you'll see from the map that the territory is the light blue. The vast majority of the world is not light blue, it's dark blue, it's residence-based, including the UK and Australia. And that's where, if you're resident in that country, you are in fact taxed on your worldwide income and gains. The vast majority of the world taxes in this way. And then the final way, which is probably worst of all worlds when it comes to tax, is citizenship-based, most famously the US, where if you are a US person, it doesn't matter where you're living, you still have to pay tax back in the US. Okay, so what I've just done now to try and put this into context for Hong Kong people is to look at government expenditure. So because obviously tax is there to fund government expenditure. So this is from the Hong Kong Census Department there, and they're talking about their expenditure. So in the last tax year, it was 609 billion Hong Kong dollars. I'm going to convert all these into the same currency in just a second, just to put it into context for you. So in Australia, their figures are also published. You can see them there, how much the government spends. And then in the UK, this came out last year, and the UK then spent £834 billion. So in terms of then comparing Hong Kong, Australia, and the UK, there's the expenditure in the local currency. Of course, it depends upon the population. So there's the populations of each of the country. This is the per capita expenditure, just to put it into context. Okay, and then let's just convert all of that on a level playing field into Hong Kong dollars. And you'll see there that the UK and Australia spend far more than Hong Kong does. That's because in the UK, we have social security, old age pensions, free hospitals, free schools, armed forces, things that we don't have or have as much of in Hong Kong. So the main reason why taxes are so much higher in the UK is to pay for those public services. Okay, so when are taxes payable then for the UK? So I've divided this into income capital gains taxes, taxes on investment property, and then inheritance tax. Okay, so the first line is then, let's assume you're a Hong Kong person living in Hong Kong, so you're non-UK resident and still non-UK domiciled. Now, if you have any UK sourced income, that's because it's UK sourced income, it's taxed in the UK, even if you're not living there. But obviously, if you have non-UK income here in Hong Kong, that's not going to be taxed in the UK. If you have UK investment property, then the income from that is going to be taxed. So any rental income is subject to tax in the UK. It's also, if you sell that property at a profit, since 2015, there's also subject to capital gains tax on it, even though you're not living in the UK or domiciled there. Prior to 2015, you wouldn't have had to pay capital gains tax, but there was a big change in the rules then. In the last 9 years, there's been 24 changes to the taxation of UK property on things like this. This is just one of them. 22 of the 24 changes were increases, only 2 of them reduced it. And then inheritance tax, if you own a property in the UK personally and you pass away, that is subject to inheritance tax of 40% in the UK. Now again, prior to 2017, if you were a non-UK domicile, you wouldn't buy the property in your own name, you would buy it through an offshore company, and then if you passed away, it wouldn't be subject to UK inheritance tax. Very big and significant change to the rules in 2017, where now owning that property through an offshore company has no impact on inheritance tax. It will be taxed as if you owned it directly, so very significant change. Any other assets you own in the UK, so if your house has got antiques or paintings or anything in it, furniture, those are all UK assets. Those are subject to UK inheritance tax upon the demise of the owner. So a UK bank account in sterling, anything else. But as a non-domicile, any assets you own still in Hong Kong are not going to be taxed to IHT in the UK. Okay. So let's say then, though, you're a Hong Kong person and you're going to move to the UK, and for a time at least, you will retain your Hong Kong domicile. So you're UK resident, but non-dom. UK income subject to tax, obviously. Now, this is where it's interesting. So even though the UK has worldwide taxation like most countries, we have something in the UK called the remittance basis, which enables a non-domicile that's resident in the UK to shield their non-UK income from UK tax. It's many countries don't offer this. Australia doesn't, for instance, but the UK does. So if you're a non-dom in the UK, with some careful planning, you can save an awful lot of tax. UK investment property, though, doesn't matter, always subject to tax. Any other UK asset, inheritance tax. But while you're still non-dom, your Hong Kong assets, your property here, won't be subject to UK inheritance tax, even if you're resident in the UK. Now, if you stay long enough in the UK, or you form an intention to settle there permanently or indefinitely, your domicile will change from Hong Kong to the UK. You'll be UK resident domicile, and then you'll be subject to tax across the board on everything, in the same way that a native-born British person is subject to full tax on their worldwide assets if they are UK resident. I'll explain a tiny bit more about the changing of domicile in a second. So let's just cover a little bit more about the remittance basis then, this great tax advantage for UK resident non-domiciles. Okay, now, you have the choice then of two different methods of paying tax in the UK while you're a non-dom. The first is what's called the arising basis, and that's, as it might suggest, you pay tax on income and gains as they arise. So any UK income and gains is always subject to tax anyway. And if you have, and it's in the same way as a resident domicile there. But you have the alternative method of doing the remittance basis. So this is where UK income and gains are still taxed. Also, if you have any Hong Kong income or Hong Kong gains that you transfer to the UK, and the technical term is remit, I'll cover more of this in a second. But anything that's remitted into the UK that's income or gains is going to enter the UK tax system and be taxed. Okay, but any income that you leave in Hong Kong, any gains that you leave in Hong Kong won't be subject to UK tax. Okay, so for each different tax year, you can choose which is the best basis for you for up to the first 15 years, possibly less, but normally 15 years. And you have until the 31st of January following the end of the tax year. So tax year ends 5th of April. You've got a few months then to decide, having a look at your financial affairs, which is the best basis for you. Now, you might just think, why on earth would anyone choose the arising basis when they have this opportunity for the remittance basis? Well, for the first 7 years, there's no charge to use the remittance basis, but from year 8 onwards, you have to pay if you want to continue using it. So from years 8 to 12, as well as paying tax on anything that you remit to the UK, you have to pay this charge of £30,000 a year. Now, if your offshore income and gains are not very high, why on earth would you choose to pay £30,000 for the remittance basis? You'd simply switch to the arising basis, okay? And then after years 13 to 15, it actually goes up to £60,000 a year. So again, another decision to be made. And then from the start of year 16 onwards, you are what's called deemed UK domicile. It basically means you spent enough time in the UK to be treated the same as a resident UK national, and you will pay tax on the arising basis. You won't be able to use the remittance basis any longer. But for the first 7 years, it is a definite advantage, especially if you have high income and gains back here in Hong Kong or anywhere else outside of the UK. So how can your domicile change then? There's basically 3 ways in which it can happen. And of course, the tax outcome is that everything you own everywhere in the world is basically subject to UK tax. So it could be a very significant difference if your domicile changes. So the first one is a simple year count. And that's if you spend 15 out of 20 years in the UK, you will automatically be deemed UK domicile. Nothing you can do about it other than leaving the UK for 6 years and then going back again. Now, this used to be 17 out of 20 years, but in 2017, they chopped 2 years off and reduced it down to 15. In theory, they could reduce it again. They could say it was 10 years or something like that. Nobody knows, but that's as it is today. The second one then is forming what's called a domicile of choice. Very, very broadly, this is an intention to settle either permanently or indefinitely in the UK. Now, clearly, if your domicile does change, you could end up paying a lot more tax. So sometimes HMRC will say, we think that you've got a domicile of choice here in the UK. It's clear you're settling here. You know, you bought property, you've got a business here and so on. So the tax collector is saying, you know, are you still in a Hong Kong domicile or has it changed? The taxpayer may want to say, oh, no, I haven't settled here permanently. My intention is to go back to Hong Kong, definitely. So if that turns into an argument between the tax collector and the taxpayer, as it frequently does for obvious reasons, it can only be settled in court. And the UK courts are kept very busy with judges deciding people's domiciles. Okay, the third is what's called a domicile election. Now, we haven't got time to cover this tonight, but that's very broadly where you have a UK domicile married to a non-UK domicile. Okay, now the point is, deemed domicile, you'll see that coming a long way off. That's 15 out of 20 years. Domicile of choice, you'll probably see that coming off in advance as well. The great news is that if you think it's going to change, then with good financial planning, you can mitigate a whole load of completely unnecessary tax bills. Okay, let's just talk a bit more then about how UK tax works. So what's taxed in the UK? I've talked about income and gains. Let's look a bit more closely. So the first is earnings and pensions. So any income from employment, self-employed or employed. Unlike Hong Kong, though, annuity income pension is taxed in the UK. It's not here in Hong Kong, but it very much is there. And obviously rental income, if you own a property, you rent it out, same as in Hong Kong with properties tax, you'll pay tax on that as well. Now, while you're in Hong Kong, those are the only taxes, personal taxes, you need to be concerned about. If you move to the UK, everything's different. So firstly, savings income is taxed in the UK. So any form of interest or in any form of coupons from fixed interest, those are fully subject to income tax. Okay. Any dividends are also taxed. Doesn't matter whether they're from a private company or a public company or even from an equity income fund. Those are taxed as well. Any insurance policy gains are taxed under something called the chargeable event rules. These are actually quite benign, and Howard will cover more of those later. And then finally, capital gains, which is strictly speaking not income, but those are also taxed in the UK as well. So if you're in Hong Kong, it's only level 1. When you move to the UK, you have 4 other levels that you need to be aware of. Now, in terms of the amount then, now I've heavily simplified this. I've got some actual numbers on the next slide. But in very, very broad terms, your income tax rate on the first 50,000 of UK income and any income that you remit into the UK, taxed at 40, and the next 100 at 20, 40, and then the highest rate is 45%. That's a very broad guide. I've got some actual numbers. In terms of capital gains tax, when you sell any kind of property, that depends upon the level of income tax that you're paying. So if you're only a 20% income tax payer, it's 18%. If you're above that, it's 28% on the gain on the property. So property has higher rates. If it's other assets like stocks and shares, mutual funds, anything like that, where you make a capital gain, it's 10 or 20%. Now, those are the rates today. You've probably seen it's announced in the US, for instance, the capital gains tax rates there are going to be going up. They could well go up in the UK as well, but I'm not the chancellor, I don't know. We did see this, though, in the Sunday Times last summer, where it was rumoured that there was going to be an increase to both capital gains tax and corporation tax. Now, in the budget, there was no announcement about capital gains tax, other than the freezing of the level, but corporation tax is going up. But this could change, obviously. Now, these are the actual numbers, though. So if your UK income and any income that you remit from anywhere outside the UK into the UK, and I've got different levels of income here, this is the actual amount of tax that you will pay. Those are the numbers. There are websites where you can input these numbers and it'll give you the outputs. And so in terms of the effective rate, because you'll always be paying some at 20, some at 40, some at 45. So even when your income is £1 million, you won't quite be paying an effective rate of 45, but it'll get very close to it. Okay, so the remittance basis then. So it's a great advantage. You can shield income and gains from UK tax by not remitting them. But it is possible to make a remittance without realizing that you've done it. And there are lots of traps that people in the UK fall into and end up with an unexpected and in some cases unnecessary tax bill. So it doesn't just apply to you as an individual taxpayer, it applies to people and entities that are connected with you as well. And these are the sort of traps that you can fall into. Now, your banker may not understand the remittance basis and what they need to be doing, and I'll show you what they need to be doing in just a second there. You will need to make sure your bank are given very clear instructions about how to operate your account. Otherwise, you could end up with a very nasty and unnecessary tax bill. Okay, now there are UK planning solutions which will solve these problems as well. Howard's going to cover those in his section of the presentation. So what is a remittance then? Firstly, any cash that's transferred into the UK. So you might have an account with Standard or Standard Chartered HSBC here in Hong Kong. If you transfer any money from that account to a UK bank account, that's a remittance. It also applies to physical cash. So if you go to the ATM here in Hong Kong, take some cash out, and you physically transport that cash into the UK, that is also a remittance. That's going to be added to your income, and it's going to be taxed. But it also applies to assets that you buy with Hong Kong income and gains. Any asset above £1,000 sterling that you buy with your Hong Kong income and gains, or any non-UK income and gains, if you buy that asset and take it into the UK, that is a remittance, and that is taxable in the UK. It's not cash, but it's something you bought with cash. So I just used the example of a painting. The only exclusions are anything below worth less than £1,000 sterling, and also things that you can wear. So watches, jewelry, clothing, footwear. Those are the only exclusions. Any other physical item that you buy, a laptop, anything worth more than £1,000, that's going to be taxable. The most common trap that people fall into is probably using your Hong Kong credit card in the UK to fund your lifestyle, to pay for things, and then paying the credit card bill here in Hong Kong using Hong Kong income and gains. That is a remittance into the UK. That is taxable to income tax or capital gains tax. If you take a mortgage out with a Hong Kong bank to buy a property in the UK, then you service that mortgage with your Hong Kong income. Because the house is in the UK, there's the connection. They've got you. The servicing of that mortgage in Hong Kong is regarded as a remittance into the UK, and that is subject to UK income tax. Okay. And also, if you take out a loan from a bank in Hong Kong, and then you provide security for that loan, and you use that loan to fund your lifestyle in the UK, the security you provide for that loan is a taxable remittance into the UK. Secondly, if you service that loan with your Hong Kong income and gains, that's treated as a second remittance. You'll end up paying tax twice. So it's very, very easy to fall into these traps. People do it all the time, of making a remittance without, in fact, realizing it. Okay, these are all remittances into the UK. It's also services provided in the UK. So again, probably one of the most common ones is that you're in the UK with your children, and you're sending them to a fee-paying school. Now, clearly, if you send your Hong Kong income to the school's UK bank account to pay your child's school fees, obviously that's a remittance. So some schools in the UK say, oh, we've got a great idea. You're from Hong Kong. We happen to have a bank account with HSBC in Hong Kong. Okay, so don't pay the school fees into our UK account. Why don't you pay it from your Hong Kong bank account into our Hong Kong bank account? That way, there's no money going into the UK, no remittance. There is a remittance because there's a service being provided in the UK, namely the education of your children, and paying it outside of the UK is not going to work. That's a taxable remittance to the UK. The other one is if you take a flight that lands in the UK or takes off from the UK to anywhere else in the world, not just Hong Kong, and you pay for that flight with your non-UK income, that is a taxable remittance into the UK because you've flown into UK airspace. That's a service provided for you and your family. So if you imagine you, your partner, your children flying Cathay business class from Hong Kong to the UK, the cost of that flight is taxable in the UK. Okay. Not only a remittance that benefits you, it's any other relevant person. So this includes your partner, whether you're married or not. Usually in UK tax, you have to be married for there to be a tax outcome. So you, your partner, any children under the age of 18, also very unusually in UK tax, any grandchildren under the age of 18. So if you happen to be living in the UK as a non-dom and you've got grandchildren there and you're paying their school fees, that will be taxed upon you as well. It also applies to any company that you're connected with as well. So if you own a BVI company, it's not, you can't really route money through there, and also to any trust that you have any connection with as well. So these rules are very, very wide ranging, very comprehensive, and they catch anything that you can think of. Okay. So in terms of the types of remittance to the UK, well, it's either what's called clean capital. That's not taxed. I'll explain more about this in a second. Any form of income is taxed then, interest, dividends, rental income, and so on. Capital gains, those are all taxed as well. Now, typically, of course, if you've got a bank account in Hong Kong and you're sending money from that account to the UK, it's actually going to be a mixture, because it's going to be a mixture of what was capital, some income was added to it from salary or interest, whatever, and maybe some capital gains as well. So before you become a UK tax resident, then everything you own is regarded as clean capital, okay? But the minute you become UK resident, this is no longer the case, and this is really important there. And remember, your UK residency can be before you actually move to the UK. It can be backdated to the last 6th of April. Now, from whenever you do become UK residents, clean capital can only be cash, and only a particular type of cash. I've got an example there. Anything else is potentially taxable. It's no longer clean capital. Now, if you've got a bank account, as most people do, that's got a mixture of capital, but any income and gains that have arisen after you become UK resident, that account is no longer clean capital. It's called a mixed fund, another one of our technical terms there in green. So if you make a remittance to the UK from a mixed fund, it's obviously not clear, well, what the remittance is. Is it capital? Is it income? Is it gains? And so on. So in order to solve this, the UK has another technical term, the ordering rules, which are applied to the remittance. And I've got an example which will do it. Now, these are generally disadvantageous because an income is treated as going first before capital gains, and capital gains before capital, because income is taxed at a higher rate. So here's an example. Let's say we've got Eleanor. She's a Hong Konger, lives here in Hong Kong. She's got an account with HSBC. As she's not UK resident, it's all clean capital. Now, she moves to the UK later in the tax year, but her tax residency is actually backdated to the 6th of April. She doesn't manage to obtain split year treatment. So, but clearly she's resident for the 2020-21 tax year, and obviously she decides to use the remittance basis because she doesn't have to pay to do so. Okay, so after her UK residency commences, but before she actually physically moves there, the bank adds interest to her account of 200,000 Hong Kong. Now, that's what's called tainting the account, because the account is now a mixture of clean capital and income. Okay, the interest, it's all cash, but there's two different types of cash in there. And there's a negative tax outcome on this, which can be avoided. So it's not a clean capital, it's now a mixed fund, because there's a mixture of what was capital and income. But the bank is unaware of the tax consequences. Ellen is still in Hong Kong at this point. So this is all happening, but a tax residency is going to be backdated, so the bank don't know the consequences. So this is what it looks like. Here, there's what was the clean capital account with 10 million Hong Kong in it. There's the interest, and the bank add that to the clean capital account, creating a mixed fund with 10.2 million in it. Now, Eleanor then, in advance of moving to the UK, she decides she wants to send some money from Hong Kong to the UK, so she's got money in the bank in the UK when she gets there. So she remits $500,000 Hong Kong dollars from this account to the UK, but it's coming from a mixed fund. So how is that treated? Well, we have to look at the ordering rules, and the ordering rules say that all the interest goes first. So this isn't done proportionately. All the interest goes first, and which is 200,000 of the $500,000, and then only 300,000 capital. So the 200,000 Hong Kong, that's subject to UK income tax, completely unnecessarily. We could have done something different and not given Eleanor a big tax bill. Okay, what we should have done is this. Here's our clean capital, there's our interest. We don't add that to the clean capital account. We set up a separate, segregated interest income account, and that interest goes into that account. That leaves the clean capital as clean capital, which means that she can remit any amount of up to the 10 million into the UK and not pay any income tax, but don't remit any money from the interest account, because clearly that's going to be taxable in the UK under the remittance basis. So a very simple bit of planning there, but the bank, if the bank might make the mistake and add it into the clean capital account, and it's trying to unmix it, forget that. Okay, now in terms of the remittance then, this is something else that you should be aware of, because it's a bit of a shocker. So Eleanor becomes UK resident, but she's still got business interests and friends in Hong Kong. One of her friends in Hong Kong says, well, I'm going to start a company. Why don't you invest in it? So she says, fine. So and it's quite a big investment. It's $1 million Hong Kong dollars of Hong Kong income and gains into the company. So now, no UK connection. This is all happening in Hong Kong. Unfortunately, the company doesn't do very well. So she decides to get back whatever she can just to recover some money back. So she sells a shareholding, but she only receives 20,000 Hong Kong dollars back. It's been a disaster. Eleanor thinks, oh, well, it's only 20,000 Hong Kong dollars. It's not a large amount of money. I'll remit that to the UK and spend it. Okay, so that's what she does. Now, when you make a remittance, you have to trace the money back to where it began life. That 20,000 Hong Kong dollars began life as $1 million Hong Kong dollars of Hong Kong income and gains. So even though 20,000 Hong Kong dollars has only been physically gone into the UK, the amount of the remittance is not the 20,000, it's the original $1 million Hong Kong dollars. That is the amount of the remittance. She will get a tax bill on $1 million Hong Kong dollars, even though only 20,000 physically has been remitted. These are the rules. They're very complicated. They're full of traps. But this is absolutely the way that it works. Okay, some people at this point say, you know, okay, well, how are they even going to know about my accounts anyway and whatever? Well, we have something since 2017 called the Common Reporting Standard. This is an automatic exchange of information. Okay, and Hong Kong, the UK, and about 100 other countries have all signed up to this, and they annually exchange information on any kind of financial account, whether it's a bank account, stockbroker account, an insurance policy, and so on. So let me show you an example of how it works. So let's say we've got Peggy. She's a Hong Konger, and she happens to have a bank account in the UK, which pays some interest. So because she's not living in the UK, she and her account are in 2 different countries, she's in scope for the Common Reporting Standard. So what the bank have to do by law is to report the existence of that account and all the information about it to the Domestic Tax Authority in the UK, HMRC. Those are the details that they'll report, all to do with Peggy. HMRC will then exchange that information with the IRD in Hong Kong. Now, because Hong Kong is not interested in offshore income, I don't know what the IRD do with that information. Who knows? It doesn't matter. Peg is not going to have to pay tax in Hong Kong on the interest. But she moves to the UK, everything's different. So Peg's moves to the UK, but back companies, stockbrokers, and so on. So those are all financial accounts. They're for each account to HMRC in the UK. And if that doesn't tally up with what Peggy tells HMRC on her UK tax return, HMRC will have some very serious questions to ask of her. So this has been around since 2017, and it's really no hiding place because 100 countries have signed up for this. Okay, HMRC also have a strategy called No Safe Havens, which is to discourage people trying to hide money offshore. And they have something called Connect, which is this computer system bought for them by BA Systems. It's got 22 billion lines of data. So that's more information than is held in the British Library. And the British Library has got a copy of every book that's been published in the UK since the 17th century and every web page that's been published since the mid-1980s. It's an enormous amount of information. And it's all about artificial intelligence, machine learning. This is not a human being doing this. And it identifies about 500,000 cases a year when there's an irregularity in people's tax affairs. So they're quite reluctant to talk about this, HMRC, but they have admitted certain sources of information that they get. So the first one is the land registry, so that this is a record of who owns what properties and so on, so they can see who owns all the property. And if there's a property there that they know you're not living in it because you've got address somewhere else, they'll expect that to be paying rental income. And if they don't see the rental income coming into a bank account, they'll probably ask you a question. And they get that information from all the estate agency websites. They also monitor, or they get feeds or data scrapes from things like PayPal and eBay, so they can see if someone's effectively running a business from home. Excuse me. They link up to all the other government agencies, so even the driver agencies. So if you're living in the UK, that they know what cars you're driving as well. They get all the information from the airlines. They know where you're flying, who you're flying with, what class you're flying as well. They scrape data from various other social media websites as well, and they get credit card information also. So these are the things that they've admitted to. They may well be getting information fed to them from sources that they haven't admitted to. But it's safe to say they've got a very clever computer with an awful lot of data in it. Probably best not to try and game the system, but to keep your tax affairs above board. They also say this as well. Some people are volunteering information to them, so Airbnb are feeding their information to HMRC as well. Okay, now there is a double tax treaty between Hong Kong and the UK, which is good. And this is designed to stop paying double tax, but it's not designed to make sure you pay no tax, okay? Various personal taxes are covered here. So in very general terms, if you've paid Hong Kong tax on Hong Kong income and you remit that income to the UK, you'll get a credit for that. But remember that tax rates in the UK are higher than Hong Kong. So if you've got Hong Kong rental income, you pay 15% property tax here in Hong Kong, and you remit that to the UK, but in the UK you pay 40% income tax, you'll get a credit for the 15, but you will have to pay the extra 25% on top in the UK. If it's something that hasn't been taxed in Hong Kong, so any kind of investment income or capital gains, that obviously will be taxed in the UK if you remit it there. And there's a link to it. Okay, that's enough of the bad news. I'm going to pass back to Howard, who has the good news, which is the solutions to all of these issues. Thank you.
Thank you, Jason. Very informative. Lots of information there. It's almost like an overload if it's the first time you've been hearing this. Now, the first thing I'd like to say is everybody's personal situation is different. So what I'm going to run through with you is just high-level, generic solutions, but each person is likely to differ in terms of the amount of money and the type of strategies we can deploy. So let's have a look and move forward in that. So in terms of financial planning, remember, we wanted to be very clearly go differentiate what is clean capital from your income and gains, and that's crucial before you go to the UK. So because if it gets mixed up, so if the bank does credit some interest to your clean capital, the ordering rules apply, and it's the highest rate of tax is paid first, basically, and then it drops down to the medium and lower rates of tax, and then finally the clean capital goes, the balance of the amount you transferred. And then you can't unmix that fund once it's mixed, and it could be a silly mistake made by a banker in Hong Kong not realizing the situation. We've seen that on a number of times. So the first thing is really just create separate bank accounts, separate from your clean capital. So any income or gains goes into a separate bank account from where you're holding your clean capital, and it's a simple instruction to the bankers to do that. Now let's have a look a bit further on them. So pre-moving to the UK. Now the first thing is, if you've got enough money, enough cash, and it's clean capital, and it's going to remain clean because you have the strategies in place for the whole period of time while you're in the UK, then a lot of the stuff we're talking about may not apply. But then, of course, if you leave it in cash and you stay in the UK for any extended period of time, the purchasing power of your money has been eroded against inflation. So many people don't like that. They prefer to have some sort of investment going on as well. So you may want to therefore look at taking your clean capital and using it in different ways and supplementing your income. And by supplementing your income, you may start liquidating non-UK assets, and then you start triggering all these issues that Jason was talking about. So let's have a look at a couple of strategies first. First one's capital gains tax in terms of pre-planning. Now, as I do it by another example, we've got two sisters, Anne and Charlotte Lau. They're both here in Hong Kong, both hold investment portfolios. They both buy shares in 2016 from Tencent for $500,000 Hong Kong dollars. And of course, if we all know what happened to Tencent, they've done very well. And as of April 2020, that's worth 1.6 million. After 2 years in the UK, they decide to settle there, but they want to buy an apartment and they need to transfer some money. So they are both using remittance basis, and they have no clean capital because it's all mixed up. So they decide to remit some gains that are potentially taxable. And as the 10 cents now has dropped down to 1.6 million, they decide to sell these. So let's look at the two scenarios if they each did pre-planning. So Anne, her calculation was this. So she obviously has a gain of £110,000, which is taxable at £22,000 or 226,000 Hong Kong in this calculation. Charlotte, though, before she moved to the UK, she took some financial advice, and it was she sold her 10-cent shares at the peak at 1.67 million and then bought them back the following day before she went to the UK. Because she was a non-resident at the time, all the gain was tax-free. So she effectively only had the cost of repurchasing the shares, which is the stamp duty. So her calculation for capital gains in the UK was only none, other than the cost of the stamp duty. A big difference by how you deal with your capital gains before you move to the UK, which is really washing them out, which is the terminology we use, and then getting them back into order before you go. There's of course on the back of that some other strategies. Another one people like using is insurance. Not in the sense of, well, I want to insure myself in the event of life or critical illness or medical insurance. Is using insurance in terms of the rules and regulations in the UK in terms of taxes. So the basic principle is if you hold anything personally in your bank account, the owner is subject to UK taxes. Now, obviously, that's only applied if you're a UK resident at the time. Now, income tax is paid on dividends or interest or rent. So if you've got a property you're going to hold in the UK, in Hong Kong or anywhere else that you're getting rent, that becomes taxable. And then any realized gains as well. So if you're holding portfolios and, you know, just sell one fund or sell one stock at a profit and buy another, that starts triggering a lot of taxes as well. And the same, by the way, with properties. So if you, though, move them into a wrapper or an envelope, as the tax man calls them, you transfer the ownership and you can move them, and that creates taxable advantages. So let's look at the website in the UK, the YouGov one, and refer to their policy on insurance policies and taxation. So this is the last updated in June 2020, and you can see we're making reference to a particular class of insurance called personal portfolio bonds. In here, as you go through it, you can see and you read through it, because it's held in an envelope, the insurance policy holder is not subject to the taxes we've been talking about, which is income and gains. So you can buy and sell inside the envelope without triggering a taxable gain. Now, of course, there is a taxable gain eventually, but that's at the end of the policy. So you could defer the issue of taxes for quite some time. So they come to an end, obviously, if you pass away, because it's an insurance. But again, you can be clever, have dual lives and things like that. Or if you fully surrender. And again, there's issues we could look at surrendering by how many mini policies you have that can obviously mitigate some of the issues there. Now, the clear thing here, though, is all income inside a policy can be reinvested and pay no tax. Whereas if you held it yourself, you could be paying only 55% of it could be reinvested if you're a high rate tax. Likewise, on any realized gains, you can invest 100% of it rather than 80% of it, because you'll be paying a capital gains tax of 20% if you're a high rate taxpayer. This is what's called gross roll up. And if you magnify that over 2, 5, 10, 15, 20 years, it's a huge difference on the performance of people's portfolios. So really, what can go inside these policies? Well, almost anything that can be easily reportable on. Now, so it's different currencies, different assets, mutual funds, they can all be pulled in. But remember, to the person who owns the policy, the individual, no taxes are paid. It defers to the ownership, which is the insurance company. The insurance company in this issue is in the Isle of Man. The Isle of Man, like Hong Kong, is not subject to tax on dividends or interest. Hence, there's no tax to be paid and passed back down to the insurance policy holders. You can even look at existing portfolios. We can look at different platforms, different bank accounts, and basically we wrap them inside an insurance policy. So you can maintain existing portfolios that you like, relationship with a personal bank you like, but we just simply wrap it around and you've got the same policy that you're running with, but you're in control of it, and then you get the benefits of gross roll up when you're in the UK. So when you come to take money out, though, what's the issue? So obviously money in, left alone, gross roll up makes a big difference. Now taking money out there could trigger some issues if we're not careful. So the first thing to do is to go back to the UK government and see what they say about this. Well, what they say is you can take up to 5% per annum based on the 5% of the premium you paid in. You can take that out on an annual basis. And if you don't take it for 1 year, you can roll it into subsequent years. So for this example is, if 5% is not taken 1 year, you can take out 10% the following year without triggering a gain and paying tax. So the issue is you could take up to 5%. So if you take 5% per year, it's all based on the original investment. So 5% times 20 is 100, it's 100%. So you can take an income into the UK for 20 years without paying tax. But if you take less, so you've got significant investment and you can live on 4% per annum, you can live for 25 years, or 3% you can live for 33 years without paying tax on your income. So the clear thing though here is, it's back to that word clean capital. We need to fund it with clean capital and not mixed or tainted capital. Now, if you make a withdrawal in excess of 5%, The amount above 5% is typically taxed at the normal tax rates in the UK, although again, it depends on the number of sub-policies we set up. There's different ways, again, to reduce the overall income tax by triggering some capital gains instead. So, however, once it's used up 100% of the premium, it just goes back to normal in terms of taxes. But in the meantime, as we gave reference to earlier, you benefit from gross roll-up on your investments. So even if we're just beating inflation by a few percentage points per annum, you roll that up for 10, 20, 30 years, that is a huge, huge difference to your investment portfolio. So let's have a look. Let's give some examples of different situations. So again, go back to a couple of sisters. This time it's Bella and Claire Wong, who lived in Hong Kong, and they want to move to the UK. They got a reasonable amount of money now. It's 50 million each. And we're going to make an assumption that any investments is simply 5% per annum on average, and it's a combination of income and capital growth. Now they're both initially planned for 5 years in the UK, and they each need in that period £120,000 per annum, 1.2 million Hong Kong to live per annum. So let's have a look. Scenario number one. So Bella, she puts aside £600,000, which is the 5 years income, into a clean bank account, segregated, that could be in the UK or in Hong Kong, but obviously it is clean, it's sitting there. She won't have to pay tax on it. She's getting an interest of 2% per annum in this one, and that's paid into a separate account. Remember our advice earlier, have it segregated away to avoid mixing it and therefore not triggering additional taxes. And the remaining 4.4 million goes into her portfolio, which is used to, and that gets the 5% growth per annum. So she remits in this situation £120,000 a year to the UK, or it could already be in the UK and she just draws it out of the account and pays no tax. After 5 years, her portfolio is valued at 5.6 million and she's got 36,000 in interest in the segregated account. So Claire, she transfers the 5 million into the insurance portfolio bond that's been referenced by the government's website, fully invests it, and she makes withdrawals every year of £120,000 by liquidating assets, and that's within a 5% allowance, so she does not pay tax on it. But because 100% has been invested, she's getting marginally more than her sister, so £100,000 more, $1 million Hong Kong dollars more at the end of the 5-year period. So that's a simple scenario of what happens over time. What if they need to draw down some cash unexpectedly? So in this example, after 3 years, they both decide to buy apartments in London. They like the UK now, they want to stay. They both want to take out £500,000 as a deposit. So let's have a look. Bella, she's got 240,000 left in a clean capital account. And she can use this, if you like, for the deposit, but that will leave her no capital left. And she needs money for the next 2 years anyway, which is broadly the same. So she decides to remit 260,000 net anyway. So she needs to send 500,000 from her portfolio to the UK, but now it's come from a mixed fund. And so the ordering rules applies. Remember, the highest rate tax is paid first. So the income tax is paid first, then the capital gains, then the clean. So in this instance, she has to transfer 881,000 to receive 500. So she's paid 3.8 million Hong Kong dollars in tax to send 500,000 pounds to the UK. Claire, her allowance is 5% per annum, which is 250. She's been using 120 of it per annum. So there's 130 of it left over that she's not been using. Now, in a 4th year, because that's when this will be, she's allowed to take down 520 of unused allowances in her 5%. So she could take that amount from her portfolio, transfer it to the UK without paying any tax. Or, importantly, by the way, I'm not sure if you've ever done one of those annual returns, she doesn't have to complete the annual returns in that regard either. So scenario 3, what if they finally decide to stay in the UK for a bit longer? Well, Bella, after 5 years, has now used up all her clean capital. She's remitted all of this, or what she can without paying taxes, and now needs to think about paying full taxes. So to continue getting 120,000, and one could argue after 5 years you may need more because of inflation, For the example here, though, she's going to need to transfer 190,000 and pay 70,000 of that in tax each year to receive what she needs to live on. Claire, as we know, she's still within a 5% drawdowns, and because 120,000 is way below the 5% allowance, she can actually take it for 32 years before she needs to start paying any taxes. So after 7 years, though, so first of all, the first stage was Bella ran out of her clean capital. Now, after 7 years, to continue on a remittance basis, she needs to start paying £30,000 per annum as well on top of the cap, on top of all the taxes. And at this stage, with all the assumptions, her portfolio is now worth 4.87 million. So far, she's paid over £500,000, 5 million Hong Kong dollars in taxes. Claire, no change. She's got £600,000, 6 million more than her sister, and she's paid 0 taxes so far. And she doesn't need to pay the 30,000. After 12 years, similar, it rolls up, but now it's 60,000 Bella's got to pay. She's continued to grow. She's got 5 million, so roughly the same amount of money she had when she left Hong Kong. And she's paid over £1 million in taxes now, 10 million Hong Kong dollars. Claire, simple, no tax paid, 1.3 million better off than her sister. So another scenario is after 15 years, Bella now becomes a domiciled in the UK, and she can no longer use remittance, and she's got to move to a rising basis. Now, that's quite generous. Last year, in the full 15 years, we see many examples where domiciles triggered way before that, but in this assumption, it's going for 15 years. Portfolio is still now 5 million, but now her worldwide gains and income is all taxable, and inheritance tax, a whole lot that's thrown in, just like any other Brit. She has to pay taxes on everything anywhere it is. So far, she's paid 1.4 million in taxes. Claire, nothing's really changed. She keeps plodding along, and now she's 1.9 million, nearly 20 million pounds better off than her sister, because she's paid no tax. Now, a completely different scenario is what we talked about there, was that IHT, the scenario, or the domicile scenario lasting 15 years, is what if they suddenly want to get married earlier on? A lot of people meet the love of their life, and especially in foreign countries, and want to get married. So after 6 years, say that happens, they become domicile. That's when a marriage or many other circumstances that Jason went through can trigger domicile. So from that point onwards, from 6 years onwards, Bella went to a rising. So very expensive decision to get married there. Her global assets and income gains a whole lot, becomes taxable globally. Okay. Claire, no difference though, because the ownership is an insurance company's name from a legal perspective. She's a beneficial owner of an insurance policy, so she gains from that. So in summary, as I said, everyone's circumstance is different. Each person's definition of how much is money they need for the rest of their lives also differs. But the thing to take from this presentation is it's complicated, the UK taxes. There's nearly 20,000 pages of it now, as you heard Jason say. The remittance definitely has its advantages, but it's very complicated. You've got to be careful, have a lot of discipline in place, and you need to do annual tax returns to work out whether you want to do a remittance or a rising. Remittance, you start paying fees after a period. A rising, obviously you don't, but you've got your global taxes to pay, although you do get your annual allowances in the UK, which is marginal. So using insurance can be a very simple, easy solution. The costings of insurance, by the way, I may hear some people ask earlier, they can vary. Of course, at BMP, we make sure it's all lean and as much as possible is returned to the client and growth. And then always, you've got to do the planning before you go, preferably the tax year before you go, because it's a clear mark in the sand of a new tax year, and there's no arguments from the HMRC. But if you've got no option but to do it halfway through the year, then we apply for a split tax year. No guarantees, but we can make an application and try and get that done for you as well. The risk of that is, though, if you get rejected, all your income and gains from the start of that tax year, even whilst you're in Hong Kong, suddenly becomes taxable. So there it is. There's the legal little disclaimer at the end. Same for BMP, I think. And we're now finishing. So look, we work as in a team. It's not just BMP. As you can see, we've got quilters here, but we work with lawyers, we work with accountants, we work with people who even help to move your pets if you want to go to the UK. So taking the loved one with you and the family with their four-legged furry ones, they can go with you as well. Sorting out education for your children. It is a big decision. We have a lot of this in a team set up. Many of you have done your own research, may not need all of that, but may need some of it. So I encourage you to contact us, and please, if you have any questions, feel free to make a contact to Jason or myself at either the emails or the telephone numbers, or whichever way you want to do that. Any immediate questions? If not, then we'll be finishing off and you can go for your evening. Okay. So far, I can't see any questions coming in, so I'll stop it there. And thank you all for coming along, and hope we'll talk to you later, but we will follow up. We'll send you links for this presentation, and all the best for the evening. Thank you. Good night.